As Dan mentioned, I am managing director with Seymour & Associates. We're a boutique investment bank focused on providing services to startup companies primarily, helping them sell, form their exit strategy, if you will, and in situations where they're also raising capital, assist them with raising capital. We also operate an early stage venture fund, so we're also investors in the space. I'd like to introduce here Peter from Amazon Web Services. Maybe I'll turn it over to you just to give you a little bit of background on yourself here.
No, the background before was pretty accurate. I've been in corporate development for about 15 years, currently at Amazon, previously at Intuit and Telenav, which is a mobile application space. And much earlier in my career, I was a banker, much like Dan. But then I decided to make an honest living, is what I like to say. So.
For Peter, my first question to you is this, because you've seen a number of startups and have acquired a number of companies in the past, both at Amazon Web Services and companies like Intuit, Telenav. What sort of attributes do you look for when you're evaluating whether a company is a proper acquisition target for your group?
So the way when on the corporate side, if you're looking at buying a company, it really depends on what problem you're trying to solve. That's what an acquisition is all about. So for some companies, they use acquisitions to drive growth. If their growth is small, then they'll say, okay, what is a new space that I want to get into? Where am I going to accelerate my growth? You're going to be buying a customer base, a revenue stream, an established business. For some companies, you're just trying to accelerate your product development, so that's much more likely to be a team and technology, and it might be smaller, it may not have any revenue at all. For others, it might just be a distribution channel to a new customer set. So, if you're a company that's talking to a potential acquirer, the first thing in your mind should always be, what is the problem that I'm solving? What's the thing that I bring to this company that they don't already have? Because that's where the conversation is really going to be centered around. So there's many answers to that question, and it really depends on what the dynamics are.
So just as an example, in the case of Amazon Web Services, I think anybody that operates in a tech startup knows who they are. But sort of what sort of opportunities are you guys looking at right now?
Oh, that's a perfect example. So the nice thing about AWS is we have the whole resources of Amazon behind us. So in theory, we could write a $500 million, $1 billion check without sweating too hard. But if you think about the scope of AWS, the customer base we have and the revenue growth we have already, 18 months on a product roadmap for us is worth so much more than 20 million, 30 million, 50 million in revenue. So a large majority of the things we look at are tech and team buys that are going to help us accelerate what we're looking to do. Now that said, there are a number of different areas in IT where we still don't touch today. And so we'd recognize that if there's a certain class of IT spend that we're not addressing today, we recognize we have to pay up for that. But a company like AWS is not going to spend money on revenue growth, will probably not spend money on a customer base. We'd likely either find technologies that we can put into our distribution channel, or we'd find an area that we don't address today at all and do something large in that way.
I'm curious, when you do identify an acquisition target that you eventually determine is the next best thing since sliced bread, you have to have it. How do these companies come on your radar map to begin with? And how would you advise startups that are perhaps contemplating exit strategies? How do they get on your radar?
Right.
And it doesn't have to be just Amazon Web Services.
Sure.
It could be, if you can provide examples from some of your earlier experiences.
Sure.
Tell it out.
Right. So there's a lot of different ways, and so one way is that you hire a skilled guy like Dan and say, hey, we've got a company that nobody knows about.
That's exactly why I asked the question. Thank you.
We're a company that nobody knows about. Who would help them think through who are the right acquirers. Oftentimes, companies are not sold though they're bought, and so in fact, more frequently, well over half the time, a company will be an acquirer will approach a company that they're already working with or already know. Because the fact is, if I'm Amazon and there's a company that can add value to us, chances are there's some business relationship that we can have that, short of M&A, that can be productive. There can be an OEM relationship. There can be a licensing deal. there can be some kind of go-to-market strategy together. And Amazon is very aggressive at trying to build out our ecosystem. One reason is because people that build on our platform are adding a lot of value, but also because the more companies we know, the more we see who's successful, the more we can look forward and look ahead. So for a startup, for a smaller company, what that means is building up your partnership is valuable not just from a revenue generation point of view, but also building those relationships that may turn into an exit later on.
What about, we were just talking about when you were at Telenav, you were involved with the acquisition of a company called ThinkNear. And I brought it up just because, our firm puts on these monthly dinner events, and we invite entrepreneurs. We're based in Santa Monica, so we invite entrepreneurs in the Santa Monica scene quite a bit to these dinner events. And I was actually sitting right next to the CEO of this company that was acquired by Telenav 2 weeks prior to the acquisition. And I killed myself for not being more.
It sounds like you're feeling, you're way over it. It sounds like.
How did he enter into your radar, Matt? How did that happen? Could you just kind of describe a little bit?
That's an interesting story. So for those that don't know, ThinkNear was a mobile advertising company that focused on location-based advertising. Their original idea had been to help restaurants fill seats. And so the original idea was, hey, if I'm Joe's Pizza or Peter's Pizza, and if it's raining out, I can send ads to people with their phones at lunchtime and direct them to my restaurant. It was in the early days of location-based advertising. What they quickly learned is, while restaurants loved that idea because they wanted more customers, there was not enough people, there were plenty of people with phones, but not enough places where they could put those ads. So they could sign up restaurants all day long, but there was no one that they could send the ads to because not enough page views had location attached to them. So they decided, instead of solving a restaurant problem of get me the people near me, they wanted to solve the problem of aggregating inventory with location. And the reason I give that history is Telenav knew that mobile advertising was going to be important. They knew they wanted to be in that business and had thought about this whole question of, do we go to restaurants or what do we do? So I met the CEO when he was trying to service restaurants in this way, and it was a mildly interesting idea. We parted friends. It was just a random meeting. And then 9 months later, they had pivoted away from the restaurant idea and more toward the account aggregation, where they're filtering mobile ad impressions by location, and therefore servicing other people that wanted to generate advertising campaigns in this way. And so a company that we met and said that you're only mildly interesting, but we stayed in touch with, became dead onto our radar screen. And the reason is, whereas originally they weren't solving our problem, a year later they were solving our problem precisely. So this was an area where just a part of my job in corporate development, anybody like me, is meant to have antenna out all the time, speaking to venture capitalists, speaking to bankers, and speaking to companies. And this was one of those areas where a line you put out a year before turned into something productive.
I guess the advice that you'd probably give to startups there is that you never know when a strategic partner like Amazon might, or Telenav in this case, might change corporate priorities.
That's right. Well, no, but I want to be clear.
Yeah.
They changed their corporate positioning not because of any input we gave them, just because they recognized the need in the market. And as it happened, that change and pivot was precisely aligned with what we want to do. Now, as startup executives, your most precious resource is time. And so you don't want to spend so much time on meetings that are not directly productive. But if there's companies that might be partners or might be acquire candidates down the road, those tend to be productive conversations. And so I'd encourage you to either have yourself or people on your staff manage those conversations, because those are important relationships to manage.
So in other words, a pivot in a startup business model should be taken as an event or an opportunity to update
Absolutely.
a strategic partner like Metallica in this case. Or
I think that's exactly right. In fact, when we first spoke to ThinkNear, it was very much about, hey, how can we partner to solve this problem? And in the space of a few weeks, we realized, no, an acquisition made the most sense. But anytime you do a pivot, it's not just about what is the new product or what's the new customer set, but there's likely to be a complete solution that includes not just your own resources, but who are the partners in that ecosystem that you're going to work with together. And so that needs to be thought through anytime you're pivoting your solution.
So I just want to step back a little bit now and ask you, your view of the current M&A market. As we all know, it's been a bit crazy out there with Facebook buying WhatsApp for $19 billion, and then it was just a couple of weeks later that they bought Oculus for just a little bit less $1 billion. And then you have companies like Uber raising $250 million last year, and then Airbnb raising $500 just a couple months ago. But what's your view of the marketplace right now? Is this the internet bubble 1.0 movie replaying again, or what's your view of the market?
So for those that weren't working back in 99, 2000, it does feel a lot like that in some ways in terms of the dollar values paid. There's a big difference though, which is that all of these companies that you're describing are real businesses. I'm not going to speak to Oculus, for example. I don't know anything about that. That seems ludicrous. But Uber, Airbnb, these are all companies that have real revenue and are adding real value. And I think one of the things that's happened is, and AWS can take a little bit of credit. What's happened in the early days was you could be very capital efficient as a startup, and what used to cost 5, 10, 15 million to scale, you needed to spend tens of millions of dollars on hardware in order just to be able to service these customers. Now what happens is customers get traction, they can start ramping up revenue and ramping up their operations much more quickly than they ever could before. And so what happens is because the barrier to entry has gotten so low, that means that the value of speed has gotten even higher. And so if you're in a competitive market, again like Uber, there's half a dozen other ride-sharing applications out there as well. If you're an opportunity to grab a bunch of land and establish a credible business, people are taking advantage of that because the dollars in are turning into dollars out very, very quickly. In the early days of the bubble, dollars in turned into users that may or may not turn into dollars out at some point in the future. Today, if you think about, again, Uber, Airbnb, all these companies, dollars in turns into dollars out so fast. And so the value and the return to scale is so high that people are betting on winners more than they have before.
And is it fair to say, because the cost to start up a startup now has come so low, that if you do start up a company, you don't see early traction, pivot and try to find another market opportunity to address until you find traction, which would be evidenced by VCs throwing money at you and growing the business to
I wouldn't call VCs throwing money the metric of success necessarily.
Well, okay, I'm sorry, but I mean, is that sort of what's happening in startup land these days?
It really depends. I mean, I think there are certain markets where once you hit growth, the growth becomes explosive. In fact, in ways that never were possible before. There are also plenty of places where slow and steady wins the race, and it's just in enterprise sales, for example. You need to be continually working on it. I think nobody ever heard of WhatsApp until 6 months, a year before the acquisition, and they were ramping users like no one had ever seen. And so I wouldn't necessarily be impatient if you're in a market and not finding success. If you're convinced that there's a problem and can be convinced you have a solution, then it's just a question of iterating on finding the right product market fit. That said, if you ultimately come to the conclusion that your idea is not the right one, but there's a more fruitful opportunity nearby, it's when you find that evidence that you've got the right solution and that you're starting to see traction, the return on the dollars at that point are so good. That's why you're seeing 20, 50, $100 million rounds, because you can see with 6 months of evidence or a quarter's worth of evidence that you found the formula. And that's what people are really reacting to.
So, as I'm a banker and you're a former banker, we all know that we'll see transactions like WhatsApp or Oculus, and we'll say, 1 in a million, right? I mean, if every day could be like that, we'd all be fabulously wealthy. But we all know that 99% of M&A activity is really, not anything nearly as exciting. Doubles and triples at best. I guess the question for you regarding that is, does that mean that, if you exit at, just a double kind of outcome or a triple kind of outcome, it's any less meaningful?
I mean, I think it all depends on why did you get started, why did you start the company, and what are your goals, right? I think, There's the people that have the bragging rights at the private jet counter, and I guess that's one metric. But most of us have long careers, and so there are plenty of people that have one success that's moderately successful, but you generate some returns for VCs, and then you've had that experience, and you can go get funded again. So I'm working on an acquisition for AWS right now, which is a relatively small deal. It's a soft landing, but the VCs are going to get their money back, and the founders are going to get some money, and hopefully they'll stay at Amazon for a while. The thing to think about in an acquisition is, unless there's some kind of life-changing thing, a month after the acquisition, you're still going to work. And so you have to define success not just by the zeros in your bank account, but did you do what you set out to do? And in this particular case, there's a pretty decent chance that this company's product is going to get to thousands and tens of thousands of customers someday. And so that can be very, very rewarding. Not everybody can work for WhatsApp,
Well, let me pivot here. Just love using the word pivot, sorry. And ask you a personal question, if I can. We talked about how you started as a banker and then eventually transitioned over to the corporate side. But how did you get into business to begin with? I'm just kind of curious myself.
So my first job coming out of Yale is kind of as I think about what I was like as a senior, you may remember, words can't begin to describe the lack of a clue that I had as a senior in college. So I kind of fell into, I was fortunate to have a technical degree, but come May, I didn't have a job lined up yet. And there was a VC firm that had an analyst take another job, and they were looking around, and I happened to be at the right place at the right time. And so this is very exciting. This is in 1993, and these jobs are very hard to come by. And on one hand, the work was very interesting. On the other hand, I hated going to work every day because the people at the firm hated each other. So it was a really toxic environment. And so while the work was interesting, it was just uncomfortable and unpleasant to be at work. But so after a few years there, I worked at a startup in Science Park, actually in New Haven, working in environmental technology. And then going to business school, I came out to California, to Berkeley. And so my first job out of business school was in banking, and that seemed to me like the right combination of technology, which I still liked, finance, which I had a head for, and then strategy as well, because acquisitions tend to be strategic questions for the most part. There's a lot of details that need to be managed, but these are strategic questions about what you want to do. So it was a really good fit for a 27-year-old coming out of school. And so I came back again to the lack of a clue. I think I kind of fell into it in each step of the way. I never really was able to look 5-10 years ahead. But I kept doing things that seemed like they would be fun. And so far, people still willing to hire me, so it works out pretty well.
I think at this point, we could probably open it up to the audience for some questions.
Yeah, we've actually probably got time for one question.
Oh,
Sorry, one question.
Sorry about that.
It's a good discussion.
Anybody? We just completely bore you guys to death? Oh, there it is. Yes.
No, it's a real good question, and every company looks at it different. I can't speak to people like Google or Intel, which are really prolific, but I can speak to Amazon, for example. An investment will take one of two forms. One would be a company that's doing something interesting that we think will have applicability in the medium term, 2 or 3 years, but we're not willing to bet on yet. But we want to bet on someone else's resources and hard work. That'll take that form, right? Another thing that'll happen, even if that's not the case, is there's likely going to be some business relationship in the short or the medium term. And so the investment is meant to support the other business relationship, because people do OEM or joint development relationships all day. So usually an investment is in support of that in one way or another, if there's additional funds that need to happen, or if there's acceleration that needs to happen. Amazon tends to look at it, it's in search of a larger purpose. I think Google tends to take and Intel too, we're feeding the ecosystem, and that's all to our greater good, but we tend to be more targeted and tactical.
Any other questions?
So at Amazon, what sort of focus do you have on integration?
On integration? Me personally or Amazon more broadly?
Amazon.
So post-acquisition, mentioned. So Amazon has done, I'd say on average, 5 or 6 deals a year, so the company's relatively good at it. We don't do huge things like Google and Facebook, but we tend to do regular. And there's a whole team within the corporate development department that is the integration team. They're actually the same as the diligence team, in fact. So the people that are driving that process are driving it with an eye toward how it's going to be integrated. Some companies like Zappos are left alone and want to maintain the brand, and some are integrated in. This one that I'm working on right now is going to be brought in, and just going to be part of the technical team of AWS very, very quickly. The bigger the company, the more customers they have, the more likely you are to keep them successful doing their own thing. But for smaller companies, you want to have to be part of the company, part of your core team as quickly as possible.
Great, so that's it for time. I want to thank Dan and Peter for coming out and speaking today.
Thank you.